Thank you very much all for coming. This is the first lecture given on behalf of the Institute of International Monetary Research. I hope it's the first of many. As you will know, I set up the Institute a couple of years ago at the University of Buckingham, and the purpose is to provide thoughts, provide research, put together conferences, lectures, to help improve monetary policy making, and indeed to show the connections between banking and money and macroeconomic outcomes. Many of you will know that I've been in this area of public policy making for, I suppose, about 40 years now. And in my view, there is an awful lot still to learn, although much of it actually is in books that were written 50 or 100 years ago, and we need, in a way, to relearn what those people said. And as you will also know, I'm a strong believer in the quantity theory of money. Now, just a few things about this evening. We're very, very fortunate to have Charles Goodhart to give the first of these lectures, and I'll just come back to that in a second. We will probably finish, I would guess, about 7:45, 8 o'clock, and then there's a small drinks reception, so all welcome to that, and I hope we can catch up. Very nice, by the way, to see many old friends here. Can I also just say a little about the Institute? It's at the University of Buckingham. We are starting, I'm the chairman, having been director for a little bit. Juan Castaneda is the first director. We are starting a MSc at the end of autumn next year, and it's going to be an MSc in money, banking, and central banking. And I gather it is the first such MSc to be given a title with central banking in it. And may I just say, by the way, Charles, that one of the things we're certainly going to be teaching is some of the things that you've said about the evolution of central banking, not least because some of the ideas came from me, but never mind. So we'll certainly have a lot about that, Charles, when we do this. And we need donations. We need money. Essentially, I've set this thing up, and for a particular purpose, as I've just explained. And so, well, donations are welcome, and obviously one of the purposes of this event is to give you that message. Charles. We are very, very lucky this evening to have Charles Goodhart to give our first lecture. I think many people here know of Charles' background in British monetary economics and policy making. Charles was at the Bank of England for much of his career, and in my view was a very benign influence on policy making when he was at the bank, and it's a shame that in the mid-1980s he decided to become an academic. So, although it sort of comes and goes a bit, but still. Charles was also one of the first members of the Monetary Policy Committee when it was doing a good job. And as I said, I think Charles's work in many areas of economics is definitive, but particularly in this area of the evolution of central banking. I had a discussion with Charles at how I was going to introduce him, and the phrase grand old man, grand suggests that you can't approach them. Old, well, but Charles didn't mind. Yes, grand old man of British monetary economics. And can I just say, Charles is very approachable, and he's very young in spirit, and we're really looking forward to hearing your talk about new and fresh ideas about what have we learnt about money and banking during and since the Great Recession. Thank you.
Tim, thank you very much. If I stop a bit early, do you think we can change a small drinks reception into a larger drinks reception? No, more seriously, I feel very honoured to be the first guest lecturer for the Institute of International Monetary Research, and I applaud its niche exercise and doing an MSc on money banking and central banking. One of the great things about Tim is that he is not a member of the mainstream, and the Buckingham and the Institute is not likely to be a mainstream institution, which is, in my view, a good thing, because as I shall indicate later on in the lecture, I think in many respects, particularly on the monetary side, mainstream economics at the moment has got things really quite badly wrong. But that really is a bit for later. Tim did comment quietly on my age, and I'm afraid once you get to the age of 80, which I did last week, you tend not to be so keen on looking forward, because the horizon is rather short, and the path is generally downhill most of the way. But one's rather keener on looking back, since one has a rather larger canvas. So I'm going to actually take you on a trip down memory lane, where I want to sort of describe briefly some of the factors that have driven macroeconomics in general and monetary economics to a degree through the last 50 or 60 years, during which I've been studying this particular field. When I entered the study of macroeconomics, I completed my PhD in 1962. It was, I think, in many ways the most optimistic decade for the subject that we have had. It brought together three things simultaneously. It brought together a generally accepted analytical structure, the Keynesian income expenditure structure, together with an increase in the availability of relatively high quality data from what was the equivalent of the CSO at that time, and the introduction of computers. And that meant that we began to be able to study functional relationships in a econometric regression least squares away. And at that time, many of us thought that this would enable us to put macroeconomics and policy advice onto a quasi-scientific basis. And we studied consumption functions, all kinds of investment functions, inventory, determinants of inventories, import functions, you name them, they were there. And we started building models. And we thought that we were going to use a relatively scientific approach to try and answer the policy problems. In practice, what this amounted to was the use of fiscal policy to shift demand in order to achieve the best trade-off in the Phillips curve. What we didn't know was that it was a short-run Phillips curve, because during the period in which Bill Phillips had studied, from the 1890s through to just after World War II, during all peacetime periods, the average level of inflation was just about zero, was slightly negative. And most people immediately after World War II were much more worried about a restoration of deflation than they were of inflation. Partly because of the disaster of unemployment in the interwar period, the optimal point in the short-run Phillips curve was thought to be a level of unemployment which was lower, and quite considerably lower than what turned out to be the natural rate, and a level of price inflation which was assessed and consciously intended to be higher than the previous average in peacetime from 1890 onwards. And again, what we didn't realize was that this eventually, though rather slowly over the first few decades, would lead to people realizing that inflation was going to be higher than zero, was going to be significant, and would lead them to try and achieve what they thought to be the best real wage contract that they could get. So we got the worsening inflationary expectations, and as a result we moved into the period of stagflation in the 1970s, which was undoubtedly the worst decade until you got to the great financial crisis in the last decade. Now, most of those at that time were perfectly clear that if you put enough pressure on demand, if you lowered demand sufficiently, if you had enough fiscal austerity and you had enough restrictive monetary policy. Incidentally, what I didn't say was in the 1960s, monetary policy was entirely predicated to maintaining the peg Bretton Woods exchange rate. What everyone realized was a sufficiently restrictive policy would eventually bring down inflation. But most of those in power and authority at the time had this very strong recollection of the disasters of the high unemployment of the interwar period and didn't want to go down that road. So while recognizing the likelihood that prices and incomes policy would probably break down, they still, at almost all occasions, preferred to try a prices and incomes control rather than go down the route of being very tough on demand, whether by fiscal or by monetary policy. Now, the incoming monetarists took a somewhat differing view, both on the likelihood of controls, prices and incomes policies working. They were correct in that they wouldn't and didn't work, and also on the likely flexibility of wages and prices. That there was a tendency for, if you like, monetarists and the currency school in general. David Ricardo always tended to believe that wages and prices were as flexible downwards as they might be upwards. So the monetarists as a whole tended to were more optimistic that you would get back to stable prices and low inflation with less unemployment than the Keynesians. There was another advantage to monetarism, which was that it was politically almost impossible for a central bank or monetary policy committee to go ahead and say that we want to set the level of the official short-term interest rate at, shall we say, 15% or 20%. And remember, during the 1970s, the inflation in this country frequently went up to that kind of level, whereas the level that was politically feasible to set interest rates meant that real interest rates remained negative throughout. And what Paul Volcker did was he espoused a form of practical monetarism, which effectively said, we are not trying to control interest rates. What we are trying to do is to control a version of the high-powered monetary base, the unborrowed reserves, and interest rates are simply what comes out in the market thereafter. Now, the Volcker approach, combined with the Mrs. T and Nigel Lawson, the medium-term financial strategy, and so on, was successful in the battle against inflation. But that success was actually achieved at quite a high price. The 1981-82 recession was quite a severe recession, and it was a particularly severe recession in some of the underdeveloped economies, such as Latin America. The Mexico, Argentina, and Brazilian LDC financial crisis was undoubtedly the most dangerous financial crisis to affect the developed economy until the Great Financial Crisis of 2008-2009. It was actually met by the central bankers around the world doing things which they would not be allowed to do now, which was effectively forbearance and evergreening. What Paul Volcker and Gordon Richardson, Fritz Leutwiler and the rest did was to tell their banks to go on rolling over loans to MAB, Mexico, Argentina, and Brazil, to enable MAB to pay back the interest that they owed to these same banks until the, if you like, the natural sources or causes of restoration could occur. Now, practical, pragmatic monetarism, which was tried fairly generally, and particularly in the UK and the US during these years, then ran into fairly considerable troubles, as we all know, because of instability in the demand for money functions, and because of the concern about which M was the right aggregate. And there were discussions within the UK about whether it should be M1 or M3 or whatever. And finally, that debate was essentially overtaken by the realization that you could finesse this, because the aim of monetarism, effectively, was to bring about price stability and to get low inflation. And you could finesse the instability in the demand for money functions by simply relating the central bank's objective to inflation, rather to the instability or to the potentially unstable demand for money functions. And that meant at the end of the 1980s and beginning of the 1990s, we moved on to inflation targetry and a shift of focus from the monetary aggregates to interest rates, the interest rate setting, the nominal interest rate, little I, the real interest rate, and also expectations of inflation, which have played center role in policies ever since then. Now that really leads us to the current state of mainstream macroeconomics, because things really have not moved on very much since the adjustments and changes at the end of the 1990s. Basically, we are still in a three-equation model, the simplified three-equation model: demand function, a supply function, and a John Taylor type central bank reaction function, expanded into rather fancier, mathematically much fancier, dynamic stability, general equilibrium models. But essentially, all of them are real business cycle, plus with the addition of price-wage frictions. Now, having got rid of the demand for money functions, or in a sense jumped over it by going straight from interest rates to inflation, what this enabled and encouraged was the exclusion of financial frictions from mainstream macro. With a representative agent model, which effectively they all are, you can't really have any default, because if there was default, either everyone would default, which would mean that the whole model would collapse, or nobody defaults. And effectively, the models all assume no default, except nowadays, a few models, for example, by Cristiano et al. In the Bundesbank and the ECB, there's some default in firms, but not otherwise. Now, in all of these models, or virtually all of them, there are no banks at all. There's no credit. There's virtually or very little in the way of risk premia. Indeed, the models are entirely inconsistent in their approach to money. They're inconsistent because if there is no default, anyone can pay for anything by simply offering their own IOU. Because without default, effectively everyone pays their IOU with 100% certainty. So you don't need money. My IOU, scribbled on a piece of paper, is as good as a Bank of England note. And effectively, Bank of England notes would disappear in a world without default. So the whole, if you like, intermediary monetary side of modern macro just basically doesn't exist. In addition, there's not much housing. The housing market, the interaction between bank credit expansion and housing booms which has played a central role in so much of our financial expansions and subsequent busts, it simply doesn't exist in these models. I was reading a latest paper by Jorda, Schulerich, and Alan Taylor this afternoon, which focuses on that interaction, and it's simply there, not there in the models. There are no liquidity-constrained households in these models. There's no transmission mechanism via the banking and the wider financial system. All there is just a direct relationship between the official nominal interest rate that is set by the authorities and expectations of inflation, which determine the real interest rate, the link from that to real incomes and inflation. And there's a paper by David Reifschneider, who's one of the more influential of the Federal Reserve Board economists, and whose paper formed the basis of Janet Yellen's talk at the Jackson Hole meeting this summer, where the whole discussion about what a central bank can do and what it might do in future is simply based around the question about signaling the future path of interest rates and trying to influence expectations. Now, having said all that, the initial response to the Lehman failure, which brought about a really serious financial crisis, was, in my view, exemplary. The decline in GDP in Q4 2008 and Q1 2009 was more extreme than happened in 1929. In other words, the initial shock was actually greater than in the interwar period. And unlike in the interwar period, the central banks reduced interest rates by something of the order of 500 basis points. Quite why everyone gets their knickers in a twist about whether the central bank would or would not raise or lower interest rates by 25 basis points. I never know. My colleague on the MPC, Willem Buter, described 25 basis point change in the official interest rate as chicken feed. Moreover, I should have said at the beginning that this is in a sense a preliminary to a conference which Tim and Juan have organized tomorrow on quantitative easing with the title Quantitative Easing, Triumph or Folly. Now, in my view, and I know there are going to be a lot of views expressed tomorrow at this conference at the IEA, it was both, in the sense that QE1 was a triumph, whereas QE3 and QE4, I think, were follies. QE1 was a triumph, again in my view, because the real concern was that everyone was terribly frightened of both the solvency of everybody else and the potentiality for illiquidity runs and solvency of themselves. That meant that everyone was hoarding liquidity for themselves and was not prepared to lend it out over the interbank market. Now, what QE, and as a result, risk premia and duration premia in financial markets went through the roof. What QE1 did was it provided so much liquidity that these risk and duration premia went down enormously. Now, because there was so little appreciation of the importance of banks, the importance of credit, the importance of money, that was not the interpretation that most of the academics and in many central banks was given to the success of QE1. Instead, they assumed that QE worked via signaling the future path of interest rates and by overcoming a degree of segmented portfolios so that people were encouraged to move into longer term and riskier assets. Again, ignoring the implication in QE3 and QE4 subsequently, of the effect of all that on the workings of the financial system, which were deleterious because it reduced the profitability. Again, just look at Ralph Schneider or Janet Yellen's paper on all this. Meanwhile, these cumulative QEs have satiated not only banks, but most other intermediaries' need for liquidity, and particularly for reserves. But the increase in the high-powered monetary base in general, and the bank's reserve base in particular, has been so large that it's actually had no effect on the growth of the monetary aggregates. I hope you can read that. The column under H, which is the monetary base, shows the percentage change in the monetary base in the US, Japan, and the UK. The middle column shows the rate of growth of broad money, and the final column shows the ratio of money to the high-powered monetary base. In fact, it's even more extreme than that, because during this period, the rate of growth of currency was growing on a fairly stable trend. And at the beginning of this period in 2009, currency represented the larger part of a central bank's liabilities. So that almost all the increase in H during this period on this particular table between 2009 and 2014 represented the increase, percentage of the increase in the reserve base of the commercial banking system. So that the increase in the reserve base of the commercial banking system in the US, for example, rose over these 6 years by a factor of 100. Now, if you had asked most people in 2004, 2005, what would have happened if the reserve base of the banking system, the reserves of the commercial banking system had increased 100-fold, they would have said we'd have had unlimited inflation. And one of my real concerns about mainstream macroeconomics is they've never really asked themselves the question why this didn't happen. Now, one of the reasons why it didn't happen was that the commercial banking reserves became interest-bearing. What happened under QE1 and QE2 was that the commercial banks had so much in the way of reserves that left to themselves, assuming that the reserves they held at the central bank were non-interest bearing, that they would have driven the interest rate on all money market assets and short-term assets such as treasury bills rapidly down to zero. And the central banks involved didn't want interest rates to go rapidly down to zero. You can look up the relevant passage in Ben Bernanke. And therefore, in order to hold interest rates at a small margin above zero, 0.5%, 50 basis points in the UK, they actually started paying interest on commercial bank reserve deposits held with the central bank. And that has meant that it actually is now the interest rate that is paid on commercial banks' reserves with the central bank that forms the basis, the key interest rate for the whole of the financial system. But that key interest rate is very closely related to the interest rates, as it has to be, on equivalent very short-term money market obligations and treasury bills and so on. And what this has all meant is that reserves, having become interest-bearing, have become just another asset class and in no sense a constraint. And indeed, the demand for reserves, interest-bearing reserves at the central bank over quite a wide range has now become almost infinitely elastic at the level of interest rates set by the central bank. I know that Tim will dispute that, but anyhow, that's what my statement. So, if reserves, cash, liquidity, deposits at the central bank no longer determine or constrain the money stock in any way, what does? And the answer that I would give, and I think Tim would have actually given himself for a long time, is actually it's not the reserve base that has really ever done this, because he and I have criticized the money multiplier approach to the determination of commercial bank deposits for many a long time. I don't know whether I can speak for Tim, but certainly what has now happened is that it's the capital regulations, the capital requirements, and not only the capital requirements, but the profitability of bank assets in many of the functions that they undertake that really determines it. Now, one of the areas where Tim and I do disagree is whether the banks did need more capital in 2008, 2009. I think that they really did. A leverage ratio, which many European banks had, of 40 to 50 times, means that if any major asset class suffers a significant decline in value, then that bank, and with it increasingly through contagion, the banking system as a whole, will get into real difficulties. Therefore, in my view, you had to have more bank capital, and the increase in the requirements for bank capital is to some large extent justified. But the problem is, once you have required banks to hold a lot more capital, how do you get them there? And here again is my criticism of quite a lot of the analysis and theory that has been done. And it runs as follows. If you take two equilibrium states that have been running in equilibrium for a long time, and in one of them, the banks have a leverage ratio of, shall we say, 50 to 1, and in the other, the banks have a leverage ratio of, shall we say, 7 or 8 to 1, then you can actually show that in those two equilibrium states, the increase in the margin, the spread between the deposit rate and the lending rate, necessary to provide the same return on equity, is actually relatively low, pretty small. I mean, David Miles has gone through the algebra, and others have done that as well. And undoubtedly, a banking system with a leverage ratio of 7 to 8 to 1 is vastly safer than one in which the leverage ratio is 40 or 50 to 1. So you've got a pretty minuscule increase in the net interest margin, offset by a massive improvement in financial stability. So it would seem to be just common sense to raise the capital requirements enormously. The problem with that was that he entirely ignored all the transitional problems. And there were huge transitional problems. The problem is effectively that when you start off with a leverage ratio of 40 to 50 to 1, you've got a massive great debt overhang. And if you are then told to shift to a leverage ratio, shall we say, considerably lower, even perhaps just 25 to 1, that is going to mean that if you were to raise additional equity, the benefit would almost entirely go to the fixed interest creditors, because it would be they who would be a great deal safer, whereas the equity holders would just be diluted, and they would find that their return on equity, their risk-return position would be vastly lower. So it wasn't a problem of what is the right end point. It was a problem about how you get from point A to point B. And the authorities effectively completely failed to assess that or to deal with it. They did with it much better in the US, because what they did was effectively they force-fed the banking system, first of all with public sector money, through the TARP exercise, the TARP stress test, and requiring all the banks who didn't have sufficient capital to take public sector funds under relatively adverse terms. In my view, the TARP financing through the TARP monies of the US banks was the best use of public sector money that has probably been done at any time in the period since the Great Financial Crisis. And yet, it has been demonized as bailout and has simply become politically impossible to consider any similar kind of force-feeding the banks with public sector funding, however much it might actually be desirable. Now, if you can't force-feed them, the only thing that you've really got left is cold turkey. And what cold turkey means is you simply say to the banks, until you get your equity up to a certain level, not to a ratio, to a level, you will not be allowed to pay out anything in dividends, and you won't be allowed to increase any remuneration or bonuses at all. And again, to some large extent, the Americans did that. And that again was relatively effective. Now in Europe, we did nothing of that kind. In Europe, we simply said the ratio has got to be much higher, and then left it to the banks to decide what to do. Well, if you were a bank CEO, the inevitable answer was that you actually do try and achieve the ratio by deleveraging. What then occurred was that there was a sort of a subtext, a form of minor blackmail, whereby each government, in effect, said to its own domestic banks, yes, go ahead and delever, but don't do it by reducing bank lending in your own country. So what the banks as a generality have done is that they have delevered by reducing cross-border lending, which means that nowadays French banks lend only in France, English banks only in the UK, and what you find in most countries is that the domestic banks in those countries have increased their bank lending within their own country by considerably more, but the overseas banks have reduced lending, so that the total growth of bank credit in these countries has gone down very sharply. Moreover, bank capital remains extremely weak, and monetary policy, through negative interest rates, quantitative easing, and even worse, these massive great fines by departments of justice on banks, not bankers, on banks, have actually had the effect of maintaining bank capital extremely weak. Bank profitability weak, bank capital insufficient. As has now been said, banks are simply not investable. And that means that it is going to be extremely difficult for banks to get out of this situation, particularly in Europe, which is the worst. Now, it may be that they will muddle through. There are powers of recovery and restoration. But we still live in a situation which the authorities have allowed to occur by, I think, mismanaging policy, in which the banking system, the financial system, particularly on the continent of Europe and least in the US, has been allowed to develop into a situation where it is fragile, weak, and dangerous. And it could be that as a result, possibly as a result of other developments, political or economic, that we do get a downturn. What can we then do? And this is my final slide. Well, we can, and I think we will, do a degree of fiscal policy. There will be a shift towards infrastructure an attempt to increase the expenditure on housing. One of the problems here is that the debt ratios and the deficits are rising, particularly the debt ratios, in a way that has never previously been the case in peacetime. There have been many occasions in the UK where the debt ratios have been vastly greater than now, after wars. But never before have debt ratios been going up so much in peacetime. So what do we have to do? If we're going to have more expenditure, I think that we need to have more forms of taxation to try and ensure that the deficit and debt are not going too much. Since Tim signalled that if we're going to have a large drinks reception rather than a small one, I ought to be finishing fairly soon, I won't go through these particular fiscal issues. I'll just end by saying that I think monetary policy is going to be in a very difficult situation next year, because inflation will be going up quite sharply, while the rate of growth of the British economy is likely to slow down. Where I think that the Bank of England will come out will depend on domestically generated inflation. Where it will come out will depend on the degree to which wage determination tries to bring about an increase and succeeds in bringing about an increase in wages growth, which offsets the reduction in real incomes introduced by foreign-generated inflation. Now, if domestically generated inflation goes up, because wage increases and earnings increase more or less in line, then I think the bank will have absolutely no alternative but to start raising interest rates, perhaps quite sharply. If wages remain low, while RPI and CPI inflation rises under the influence of the lower exchange rate, then the Bank of England, I think, will maintain a very expansionary policy. So the key issue to look at for monetary policy in the short run is what is likely to happen to wages rather than anything else. So anyhow, on that note, I will stop. I hope we've left a little bit of time for discussion. Thank you.